Welcome to the CMA exam support package. We are in section A, which is external financial reporting decisions, and today we are going to discuss the subtopic A2, which is recognition, measurement, valuation, and disclosure, which contains 9 MCQs. So let us begin with the subtopic A2. A change in the estimate for bad debt should be. So there are various types of adjustment, like we have change in accounting principle, we have change in errors, and these two are the change in errors, and we have change in accounting estimates, and we have change in reporting entities. So we have various types of adjustment. Let us how it is done. Change in accounting principle, for example, you are changing from LIFO to FIFO, you are changing from average cost to FIFO. So these changes are classified as changes in accounting principle, and the treatment that is done is retrospective. This means you have to go back to your financial statements and you have to change, because the treatment that is done is retrospective. Now the other change is that it's the change in errors, correction of errors, or change in errors or correction of errors. So correction of errors can happen in the prior period, or the correction of errors can happen in the current period. If the correction of errors happen in the prior period, then you have to go back to your financial statements, and the treatment that is done is retrospective. So the example of correction of errors can be that there is a misallocation of expenses in the past. So the treatment is that you have to go back to your financial statements and you have to change it. So the treatment is retrospective. Now correction of errors in the current period. If it is in the current, so you don't have to go to your financial statements. The current year is corrected at that time only, and it does not require any retrospective adjustment. So the error can be recording a transaction in the wrong account. So we can record a transaction in the wrong GL account. So it's a current period error in the current period only. Prior period you have to adjust, you have to go back to your financial statement and restate, because it is retrospective treatment. Now we have the other changes that we have accounting estimates, change in accounting estimates. So when there is a change in accounting estimates, so that is done prospective. Prospective means the effect in the current period plus future period. So effect will be in the current period plus the future period that is going to come. So changes in accounting estimate is done prospective, and changes in reporting entities. Changes in reporting entities is, for example, we are going to merge with some another company. So that is done retrospective. A change in the estimate for bad debt should be. So here a change in estimate. So a change in estimate is what? It's here. A change in accounting estimate. A change in accounting estimate is done prospective, which affects the current period plus future period only. So let us see. Treated as an error. Changes in an accounting estimate is not treated as an error. It is not handled retrospective. It is handled prospective. Considered as an extraordinary item. Changes in estimate for bad debt is not treated as an extraordinary item. Treated as affecting only the period of the change plus the future period, plus the current period plus the future period. So this is the correct option. Next, Finer Foods Inc., a chain of supermarkets, a chain of supermarkets specializing in gourmet food, has been using the average cost method to value its inventory. So this chain of supermarket is using average cost method to value its inventory. During the current year, the company changed to first in first out inventory valuation. So what this company is doing, this company is changing from average cost to first in first out. So this change from average cost to first in first out is the change in accounting principle. So the change is change in accounting principles. Change in accounting principle should be treated as retrospective. Change in accounting principle should be treated as retrospective. So let us see. The president of the company reasoned that this change was appropriate since it would more closely match the flow of physical goods. The change should be reported on the financial statements as cumulative effect type accounting change. It's not a cumulative effect type accounting change. Change in accounting estimate. This is not change in accounting estimate. It is not change. It's not a correction of error, but it's a change in accounting principle because the company is changing from average cost to FIFO, which must be treated as the treatment must be done as retrospective. So the correct option is option B. Next, Best Billiard Company owns 40% of Supreme Tables Company stock at a historical cost of 300,000. Supreme Table recently reported their earnings for the prior year. Best Billiard's proportional share of Supreme Table's prior year net income was 10,000. So Best Billiard is the investor, and his share of Supreme Steel his share was 10,000. So in the income, Best Billiard proportional share of Supreme Steel's prior year net income was 10,000. Best Billiard also received 15,000 in dividends. So what happened? Best Billiard is doing an investment of 300,000, and the share the Best Billiard owns is 40%. Best Billiard owns 40% and the investment is 300,000, and he receives an income, his share of income. Best Billiard's proportional share of Supreme Tables prior year net income was 10,000, and he is also receiving a dividend of 15,000. Best Billiards uses the equity method. So the method that is being used is the equity method. As an accounting treatment for the investment, based on the information presented, the proper presentation of the investment would result in the Best Billiards reporting. So they are asking about the investment. What would be the investment? So proper treatment for the investment. So under the equity method, what we do? Under the equity method, first we are going to record the original investment at cost. So the accounts that we are going to debit the investment account, and we are going to credit the cash or bank. So initially what the company has done, the company has invested 300,000. The company has invested 300,000, so the investment account is debited by 300,000. And the second treatment is that includes the pro rata share of investee's net income and loss. So here the investor is getting a return of 10,000. So by 10,000, what happens? The investment account will increase by 10,000. So here pro rata share means if the investee is getting net income, if the investee reports net income, the investor's investment account is going to increase. So the entry by net income, the investment account is going to increase, and we are going to debit the investment account, credit the income from investment. If there is a net loss, it is going to decrease your investment account, that is loss from investment, and credit the investment account. And the third treatment is that if any dividend is received, it will reduce the investment account. So dividend received will decrease the investment account. So in that, what entry do we pass? We debit the cash and credit the investment account. So firstly what we do, we are going to record the investment account at cost, that is debit investment and credit cash. So this is 300,000, and includes the pro rata share of investees' net income and loss. If it is net income, it will increase the investment account. We are going to debit the investment, and our share was 10,000. So by 10,000, the investment account is going to increase, and there is no net loss in this MCQ. But we have received certain dividend. So dividend received will decrease the investment. So what entry do we pass? We debit cash and credit investment. So by 15,000, your investment account is going to decrease. So let us now let us calculate the value, that is the change in the investment account. So initially we recorded the investment. We have to record the investment at 300,000 plus we got some income. Our share of income was 10,000. So by 10,000, the investment account is going to decrease, and if we are receiving any dividend, that will decrease our investment account. So by 15,000, our investment account is going to decrease. So by calculating this, we get 295,000. So our investment account has fallen from 300,000 to 295,000. So the fall is 5,000. So the correct option is that a decrease in the book value of their investment in Supreme table. So there is a decrease in the book value and the amount is $5,000. Next. Under US GAAP, which one of the following statement best describes the effect on the financial statements resulting from a change in accounting classification for a security for available for sale to held to maturity? So here what we have done, we have classified a security from available for sale securities. Before, the security was available for sale securities. Now the security has been changed to held to maturity. So there is a change. So there is a change in the classification, that from available for sale securities we are moving to held to maturity security. Now what happens in available for sale securities? In available for sale securities, the securities can be treated as current or it can be non-current. The securities are debt and equity, and it is treated as a fair market value. So any unrealized gains and losses it's a part of comprehensive income, and that is reported in the balance sheet. And any realized gains and losses that goes to the income statement, interest and dividend also goes to the income statement. Held to maturity also, it is similar to available for sale securities. It can be non-current and current, but the major difference is that it has debt and equity, but here only we have the debt only. The other difference is that it is carried at fair market value, but it is carried at amortized cost. Held to maturity securities are debt securities only. They are carried at amortized cost, and we don't have any unrealized gains and losses in held to maturity securities. So this is one of the major differences that is being tested in this MCQ. There is no unrealized gains and losses in held to maturity securities, and income statement we have the same effect. That is, realized gains and losses goes to the income statement, and interest income also goes to the income statement. So let us see. Comprehensive income. Now we are in held to maturity security. We are not in available for sale security. So comprehensive income will be impacted in the future by unrealized gains and losses. In held to maturity securities, we don't have any unrealized gains and losses. The balance sheet will be impacted by unrealized gains and losses. How the balance sheet is going to impact? Because in held to maturity securities we don't have any unrealized gains and losses. No change will occur regarding the accounting treatment for unrealized gains and losses. There is a change because we are shifting from before. What we used to do, we used to report the unrealized gains and losses on balance sheet as a part of comprehensive income, but now we are not going to report any unrealized gains or losses. So no change. There is a change in the reporting of unrealized gains or losses. So the option B is correct because net income will not be impacted in the future by unrealized gains and losses, because in held to maturity securities we don't have unrealized gains and losses. Next, a company has 100 million of debt that is due in March year 3. In December year 2, the company entered. In December year 2, what the company is doing? The company is entering into a non-cancelable agreement with its lender to refinance the debt with the same interest rate, and the full principal is due in December year 5. How should the debt be classified on the December year 2 balance sheet of the company? How should the debt be classified on the December year 2 balance sheet of the company? So year 2 December, and we have a debt that is coming due in year 3, that is March. So in December year 2, the debt is current. So this debt is, which is of 100 million, which is due in March year 3, that is current. Right off now it's current because we are going to prepare our financial statements in December year 2, and we are standing here and we are going to create our financial statements in year 2 December. So, and the debt is due in year 3 March. So this is the current liability, because you are current liability. The definition of current liability is that current liabilities are the liabilities that are due within 1 year or the operating cycle, whichever is longer. So this is due within 3 months or 4 months. So that's why it's a current liability. But here there is another transaction that happens in December year 2. What happens in December year 2? The company entered into a non-cancelable agreement. The company has entered into the agreement, which shows that the company has the intent and ability to convert this current liability into something else, with its lender to refinance the debt with the same interest rate, and the full principal is due in December year 5. Now this year 3 debt of 100 million is being shifted to year 5. Because the company has entered into a non-cancelable agreement. So now the debt is to be paid in year 5, and you are creating a financial statements in year 2. Before it was current liabilities, now it's a long-term liability because it will get due in year 5. Next, which one of the following transaction would affect the retained earnings but not additional paid-in capital? So which one of the following transaction would affect the retained earnings but not additional paid-in capital? So here what happens? Retained earning should be affected, but your APIC should not be affected. So we need to find a transaction which affects retained earning but it does not affect your APIC account. Declaration of a stock dividend. So when you declare the small stock dividend, what entry you are going to pass? The entry that you are going to pass, you are going to debit the retained earning account, and you are going to credit the common stock and APIC. So with this transaction, declaration of a small stock dividend, your retained earning is affected, your retained earning is debited, and your common stock is credited. So here what happens? Your both retained earnings and APIC is effective. So this transaction affects both. Now, decrease in the value of available for sale investment. So decrease in the value for available for sale investment, it will not affect the retained earnings, and it will neither affect the additional paid-in capital because it goes to the other comprehensive income. So it is not part of retained earning, and it is also not part of additional paid in capital. Now, purchase of treasury stock using cost method. So when we are purchasing treasury stock at the cost method, what entry do we pass? The entry that is passed, the entry that we are going to pass is, we are going to debit the treasury stock account and we are going to credit the bank account. So in this, what happens? Your treasury account is affected and your bank account is affected. So there is no effect on retained earnings and EPIC. So there is no effect. So here, purchase of treasury stock, there is no effect on both retained earnings and EPIC. Here also, decrease in the value for available for sale of investment. So there is no effect. Here, this transaction is going to affect both, but impairment, so we are left with the impairment of long-term assets. So impairment of long-term asset is a loss on the income statement. So if it's a loss on the income statement, what happens? Your net income is going to decrease, and net income is close to retained earnings. So if the net income decreases, your retained earnings will decrease, which will affect your retained earnings. So by this transaction, your retained earning is affected, but your EPIC, there is no effect in EPIC. So this MCQ is being asked for this transaction which affects the retained earning, but it is not going to affect your additional paid in capital. So option C is the correct option. Next. During the month of October, a company purchased 1000 units of inventory for 500 per unit and sold 900 of these units, which represented 10% of the company's annual sale budget in units. The company also incurred administrative cost of 300,000 during October. By applying the matching principle, the total amount of the company's expense on its October income estimate. So here they are asking about the company's expense by matching principle. So what is matching principle? Matching principle is that you are going to match your current year expenses with the current year revenues. Current year expenses are matched with the current year revenues. Now the first expense is, we have incurred administrative cost of 300,000. So the expense, company's expense, the first expense is 300,000, and the second expense is CGS. This is admin, and the second expense is CGS. Because what happens, during the month of October, we have purchased 1000 units of inventory for 500 per unit, and out of which we have sold 900 of these units, and some of the units are still in our ending inventory. So we have sold 900 of these units. So when we are going to sell 900 units and we have purchased these units at 500 per unit, so this gives you 450,000. So 300,000 plus 450,000 comes to 750,000, which is option A. Next. A company is preparing financial statements in accordance with US GAAP. Listed below are select financial data for the company. We have net income, depreciation, investment by owners, unrealized gain on available for sale securities, foreign currency translation loss. What is the amount that would be reported as comprehensive income? So we need to understand what is comprehensive income. Comprehensive income is net income plus OCI. So OCI is other comprehensive income. So we need to find the comprehensive income, which starts from net income, and we add certain item in OCI. So what are the items that are being added in OCI? That you can remember through the mnemonic called DENT. So you need to add certain item that is 10th and you will get the comprehensive income. So let us calculate here what happens. So we have a net income. So while calculating the comprehensive income, we start with net income, that is 950,000, which is here it's 950,000. Now we have to calculate other comprehensive income. So other comprehensive income, the items that are included in other comprehensive income is DENT. So DENT stands for, D stands for derivative cash flow hedges, E stands for excess adjustment of pension, PBO and fair value of planned assets at the year end, N stands for net unrealized gains or losses on available for sale securities, T stands for translation adjustment for foreign currency. Then we will get other comprehensive income. So let us understand. Depreciation is already included in net income, so we will not include the depreciation here. Investments by owners is this is part of equity, so we are not going to record this transaction here. So 60,000 will not be recorded, depreciation will not be recorded. We will start with net income, that is 950,000, and unrealized gain on available for sale securities, that is net unrealized gains and losses on available for sale securities. So we have got a gain which is of 90,000, that must be added, plus, and we have foreign currency translation loss. So we have incurred a foreign currency translation loss which is 20,000. So foreign currency translation loss must be deducted. So we get other comprehensive income which is 70,000. So comprehensive income is net income plus other comprehensive income. So net income is 950,000 plus other comprehensive income is 70,000. 950,000 plus 70,000 comes to 102,000, which is 102,000. So the comprehensive income is 102,000. Next, a fundamental difference between US GAAP and IFRS is that, so let us see the difference between IFRS and GAAP. FIFO is allowed under IFRS and FIFO is allowed under GAAP. The average cost is allowed under IFRS. It is also allowed under GAAP. So the difference is in the in LIFO. So LIFO is basically allowed under IFRS. That is last in, first out. So it is not allowed. Sorry, the LIFO is not allowed under IFRS, but it is allowed under GAAP. Now we have valuation of inventory. We have two methods to value inventory. We have net realizable value rule, or we have lower of cost or market rule. So NRV is allowed under IFRS. The NRV rule under IFRS is applicable to every method of inventory that we use, but this NRV rule is not allowed under US GAAP for LIFO and retail method, but the NRV rule is allowed for FIFO and average method, and it's also allowed for all other methods. So here we have little differences. NRV rule under IFRS is applicable to all methods, but the NRV rule under GAAP is not applicable to all methods. So this is not allowed for LIFO. When you are using LIFO method and retail method, you can't value your inventory using the NRV rule. NRV rule is applicable to all other methods that does not use the LIFO or retail method. For example, it can be FIFO or it can be average cost method. Now, LCM rule. LCM rule is not allowed under IFRS, but LCM rule, which is lower of cost or market rule, is allowed under GAAP, but it is only allowed for the method related that you are using LIFO and retail inventory method. Now, written down of reversal. Written down of reversal is allowed under IFRS, but it's not allowed under US GAAP. US GAAP does not allow the write down of reversal, and admin and selling expenses and abnormal spoilage is excluded under IFRS and GAAP. So These are some differences related to your inventory. So now, a fundamental difference between US GAAP and IFRS is that reversal of inventory write-down is permitted under IFRS. Reversal of inventory, so this is asking for write-down of reversal. So reversal of inventory write-down is permitted under IFRS. Yes, it's allowed under IFRS. Now, reversal of inventory write-down is prohibited under US GAAP. Yes, it is prohibited under US GAAP as it's not allowed under US GAAP. So this is the correct option. Distribution B and D. There is no difference in distribution cost and marketing cost. Distribution costs are included in cost of sales under US GAAP. However, distribution costs are excluded. There is no difference in distribution costs and marketing costs. But inventory is generally valued at lower of cost or market under IFRS. Under IFRS, we use NRV rule. We don't use lower of cost or market. So lower of cost or market is used in GAAP and it's not allowed under IFRS. So because of this is incorrect option. However, inventory is generally valued at lower of cost or net realizable value under the US GAAP, but it's only allowed for LIFO and retail inventory method.